You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Okay, so my name's Jack Mohr. As Howard said, I work directly with Jim Cramer. I run his charitable trust, and so I invest Jim Cramer's money. I've made a lot of mistakes. I've had some successes, but ultimately I've learned humility. And so for this presentation, I kind of wanted to go through really inside the madness, truly. So just a little context. I had worked with Jim. I had been at Barclays as a sell-side research analyst and joined Jim to be research director for Mad Money. And almost overnight, I was appointed to be the portfolio manager for the charitable trust that he runs. How many of you guys have heard of the charitable trust that Jim runs? Okay, so it's so when I found out, I was forced to have I was not wearing nice clothes, as you can see, and they fitted me with like awkward suits and a really long weird tie, and essentially you could see on my face that I was scared. I had no idea what to expect, and I was the new portfolio manager. Of all the videos we've ever done, that got the most clicks. And so, my wife and really myself, not too proud of that, but it does kind of exemplify, we're going to just go back to it, what the position I was in when I first joined as running the charitable trust. I was a little bit in over my head, a little bit nervous, and I was freaking nervous, and I was looking like a cherry boy right there, and it was. So that is like the one picture that makes us, as I define as success, that looks successful. That's right before what we do, a members-only call. I do have a broken wrist there, and it was because I was sober and fell down stairs at my friend's bachelor party. So, but the successes so. What we've learned, I'm going to walk it through in real examples, is that some of the mistakes, a lot of the mistakes, have been when I've panicked amidst conviction, or when I've had hubris, pride, instead of humility. And I think that if you flip that around, you can learn to kind of develop a strategy that can at least keep you on the level field with the markets, and I think it's very important to be humble. But without further ado, this is another picture. We stood back to back for about an hour for that photo shoot, which is extremely awkward. But bottom line is that the learning lessons, as you can see, is that you don't have to be perfect. Anyone who has a crystal ball wouldn't be here, and no one has a crystal ball. I definitely don't. But practice self-awareness. And I think as you'll see, and kind of as I go through some of the specific investments, you're going to see a lot of Jim's emails. Not his email address, but I do have his permission, kind of, to show some of the emails during the difficult times and the good times. But I truly believe that you can build wealth over the long term, and that as simple as it sounds, discipline and patience does pay out, because lack of discipline and lack in impatience leads you to have some pretty uncomfortable conversations every single morning that I sit down with Jim. So, and I also think it's important for every investor to do your own homework, be a shareholder. So let's kind of go into the meat of it. Let's go right into the madness. So hubris over humility. So I stepped in. I had an investment idea. Who's heard of Halyard Health? Anybody watch 60 Minutes? So that was my first investment idea. I'd spent over 100 hours at least studying the company from every dimension. I thought I knew it. It was a medical devices company spit-off from Kimberly-Clark. Nobody was covering it as a research analyst yet on the sell side. and I saw an opportunity. I had dug in. And I don't know if this video will play, but essentially, the bottom line was that Jim introduced it to all of our members who subscribe to the Charitable Trust and the Action Alerts Plus portfolio, and said this was Jack Mohr's name. He spent all the time, and it was true. I had the thought leadership on it. They had a great fourth quarter results. So out of the gates, it was sterling for me. And you can see on that, that's the face of hubris. This was a stock that I had pounded the table on. I came in hot, with the first few months, and it was up 10, 15%, and I was getting all the accolades. I thought I was basically invincible. Unfortunately, that didn't last long. So what happened was Halyard then had a pre-announcement for its next quarter. Shares were down 10%, and Jim, I remember we were talking, and he said, look, he's like, you know more than anyone about this name. You've done the research. Do we stay in it? And I said, yes. It was confirmation bias in the most classic sense, but I truly believed that I think it was a mix of me believing in the story and and really turning blinders onto the facts. And that was the denial. And I dug in my heels. And I paid the price for it. So that's when the surrender happened. It then had the next quarter, another pre-announcement, down another 10%. So now we're down 25% on the name. Let's just say that conversation in Jim's office was exactly like the conversation with the CEO on Mad Money. You can see Jim's face right there. Flip it on the right side, the face of the CEO of Halyard. That was me for about 1 hour and 15 minutes that day, that morning. And Jim was rightly upset. I had made a mistake that was truly bred in hubris, truly bred in pride. And that pride, even though I had done all the work on the name, was meaningless because I was unwilling to admit when the facts changed that I didn't change my mind. And that lost people money. And that really brought me, it was the first, the fact that I still had a job after that was impressive in and of itself. But it really taught me a lesson in humility and in kind of just being able to admit when you're wrong. I think that's critical. So then, this is kind of the overarching pastiche, very simple. I mean, we're humans, right? I think that's very powerful. I think it's also very fallible, at least for me. We're fallible in the investment sense. When we rely on just our reactive, the first instinct you have, that panic or that excitement. That is something that is triggered in our DNA. It's in our wiring. Intuition is somewhat helpful, but in and of itself, your initial reaction when something happens to a stock, and in my view, and your intuition, if that drives your investment decisions, it led me, has led me into investment traps, and I think it's led a lot of other people. Now, I think there is a powerful side of our humanity, and that's the reflective side. And I think reactive's never a helpful side for investing, but when you take intuition and reflection, and you take some time, I think there are opportunities to take advantage of the market's psychological traps and being on the other side. Now, I think I had to address Twitter. Twitter is obviously a name that, how many of you have traded Twitter? Okay. We can all, my name is Jack Mohr, and I've traded Twitter. And so Twitter was the dog that never slept. For us, I did kind of inherit it in the portfolio, but I believed initially when I listened to their, I think, fourth quarter results on the call and the opportunity. And it's been a tantalizing trajectory. We have recently exited it, but this shows you kind of the ups and downs. We're going to go into it very quickly. Is initially, Twitter beat on the earnings. I think this was the fourth quarter results back in last February. And that got me bulled up. That got me excited. Listening to the conference call as a sell-side analyst, seeing covering restaurant stocks and covering retail stocks, supermarkets, drugstores, dollar stores, and GNC, Herbalife, and all of that. Actually seeing a growth opportunity was very exciting for me. But what happened was as soon as it was really, as you could see, this was under my name. I started to realize that Twitter had the vast opportunity was just there was no clear path to actually monetizing it, and it was a point where I had spoken with Jim and we decided to sell, but we didn't sell all of our position. That was a big mistake because we had really reflected on it. We had done rigorous analysis on it, and we had listened to the conference call. And who remembers when Jack Dorsey, with his 10-foot beard, was on that conference call, basically not admitting that Twitter had made any mistakes after they had shown extreme deceleration in users. Does anybody remember that call? Yeah, that's why management teams should never have a video conference call, because you could see so I turned into the Twitter bear. And this was kind of a somewhat confrontational with Jim. Jim, I think, saw the opportunity that I had seen, but I was appointed bear. I started making I got into a lot of Twitter battles about being a bear on Twitter, and I was supposed to go on a bull bear debate on CNBC. I was going to be the bear. Now, the 6th word no bear ever wants to hear. Jack Mohr is bullish on Twitter. So this is what happened. So I was in the studios for CNBC. I was about to I had my bear argument all, thought out. I thought I was going to go against a bull. 5 seconds before it went live, I hear in my ear, "Oh, you have to be the bear." That's the face of someone who just found out that you have to be the bull. That's the face of someone who just found out that he has to be a bull on the stock and the company that he has, that I had really, truly grown to despise and grown to see extremely little value in. But this is a very kind of nuanced situation because there was always that hope of the takeover, and there was always that kind of the phoenix type rising that Twitter would always give you, just enough to stay in 0.99% of our portfolio. We eventually got out, and I initially framed it as, hey, we got out, shares were up 40% in 3 weeks, or maybe three, whatever. It said there it was, and in the rally over the past 2 months, 25% since July 27th. And then I spoke with Jim, and Jim was like, you know what? We're selling out at a 27-30% loss. Let's not try to frame it as something that is a win. And so that's why I said that, this isn't about the 25% gain in the last few weeks. This isn't about the 40% rally over the last few months. This is about the fact that we sold out of the remaining position for a loss, and a pretty big one. And I think that was something where it's all about framing, and I believe that you have to be honest about when there are losses, and you have to be honest when you've made mistakes. And although we had sold out a lot of Twitter at 36 or 40, we wrote it down to the 20s, and even though we had lost conviction in the story. And the lessons: challenge your own assumptions. When the facts change, this is a quote by me. No, I'm just kidding. It's a quote by someone much more famous. When the facts change, I change my mind. What do you do? The other thing, never share CEOs with another company. I really think that is something that is truly underestimated or underappreciated, is that as incredible as Jack Dorsey is, and I think when Jim has met with him many times and he sees just an unbelievable potential, he hasn't been able to unlock it, and he runs 2 companies. No CEO can run 2 companies of major organizations. Potential does not equal outperformance. Never own stock for a takeover. If I had $1 for every single takeover rumor that I received as an alert, I'd be worth maybe $500. And so, and so I think these are lessons that Twitter was a hairy situation, but we got out of. Now here's about conviction. I know a lot of the conversation has been about active trading, passive trading. Do investors ever really have an edge? I think that the answer lies somewhere in between. It's very difficult to build an edge. But I'll show you an example of a situation where conviction and building an edge truly was powerful and made people money. And so my first day on the job, this will play back, this is the email from Jim, Jack, with 50 font as anyone last night. I swear to God, he has 50 Arial font in all of his messages. So first message I get from Jim when I join. What's on your mind? We're ready. 2 minutes later. So Jack, blank, follow up. I hadn't even set my Outlook yet. This was back in 2014. And sorry, guys, this was in my spam. That's a lie. It was just, I had woken up on Saturday and seen 2 emails from Jim asking for my best ideas after being 6 hours into the job. But I knew that one of the companies I'd become obsessed with, and you'll see the obsession, was NXPI, NXP Semiconductors. Who's heard of it? Okay. So for those who haven't heard of it, you've used it. 100% sure. They're in the iPhone. They've created the technology behind Apple Pay. They created near-field communications. They're the chips inside, or they have been the chips inside the EMV chips, and providing contactless transactions. But they have emerged as the leader in autos. And this is a company I'd been following very suspiciously, very kind of in a creepy manner for a long time, and I'd become quite obsessed with it. And so this is where idea generation starts to build. So this is going back to 2014. So this is my obsession with NXP. I reached out, kind of a initial reach out to after following them from afar, to attend their analyst day. The answer, unfortunately, seats are booked. I made a call to him and made a very strong plea, and all of a sudden, I had interviews with the founder, CEO, and all of these other people. I think it was more they felt badly for me, and they had seen that I was truly obsessed with this company. And for better or for worse, I appreciated the company when a lot of people didn't. And this was kind of, I'm just showing some of the emails that Jim and I, would exchange over time. But we didn't invest in the company until we had waited for it to come below our fair value. But I had spent, by my own calculations, I believe almost 750 hours studying this company from every dimension. Speaking with the management team, speaking with the CEO, speaking with every single product head, going to their actual facilities and trying to figure out, is what they're saying, is that actually something that they can unlock? Well, it was exciting. Jim got excited about it, and we eventually invested in it. And there's a gut check. This is all about intuition, and I think this is the most important point, is that when you build an edge around a company and when you truly develop thought leadership, it is about you need to stick with the facts and your gut. Or you can have, as I did this past April, meetings with dinner, or I guess it was kind of it was like 3 p.m. I'll remember it very specifically for a specific reason. I showed up. It was a CEO, CFO, COO, and a few product heads, and the head of PR. And then this is where the gut check comes in. I was eating some of the fish, and I started choking on a fish bone. The next 5 minutes were I don't think even embarrassment would really encompass it. I choked on the fish bone. The CFO was, after 2 minutes, I drank a little Diet Coke, and I couldn't get it out, and the Diet Coke was a bad idea, and I literally threw up on the lap of the CFO. So I vomited on the CFO of one of the largest companies in the world. I had the COO then went to the bathroom, and I believe he threw up, and I never saw him again. And I remember saying, well, the one thing I got out was, we'll laugh about this at one point. And so I'm not lying about this. You can see the email to the poor PR head. Well, quite amazed to meet you. She had just joined. Can't help but laugh at myself at this point. way to make an introduction. And she goes, they've probably already seen me on the creep sign. And she said she was, really bless her heart, all good, just glad you're okay. Now, that's about building an edge. That's if you have the situation where you have gone so deep into the company for 4 years that you're able to throw up on the lap of the CFO, really lose the COO, and I don't know if you ever came back to the company after that moment, and then carry on for another hour. I mean, the dinner had just started. That's where I started to put conviction into action, and we couldn't, we initiated on the name, we'd added to it, and basically me, I wrote a lot about it, and it was extensive, but it was frustrating because it was kept trading at 12 times earnings despite the growth potential. And, well, here was from the other day, here's an email exchange. We find out that Qualcomm is, a big company, obviously, it was in talks to take over the NXP. And as my analyst said, holy shit. And Jim, oh boy. And the next conversation, Jim called me and he said, okay, what do we do? And I said, I think we sell a third of the position on the spike. It's a rumor right now. But we ride out the other 2/3. And I believe that the value of the company, they would not, this Rick Clemmer, the founder, the CEO, the man who had truly been part of my life, and parts had been, expressed quite, figuratively and literally in front of him. I knew that he was someone who viewed his company as severely undervalued, and that just given the past, the trajectory, and I could go into in other conversations we laid out, he wouldn't accept a bid under 115. So I said, but it's important to sell out, to trim a position. We'll get to autonomous driving. To trim a position, we trimmed a third of it. We've gotten a lot of kind of lashback for it. It was at 96. It subsequently went up to 105. But you got to lock in profits at some point. I think that's what people don't, fully appreciate, and I don't fully appreciate, is that as much conviction as I had in the company, we initiated back, a year ago with a 110 price target when the shares were trading at 80, 85. We bought when it was at 78. It was a company that no one appreciated, and finally the Qualcomm bid illuminated the fair value, and that's why even with the lack of kind of substantive reports outside the fact that Qualcomm needs them, and at the end of the day, Qualcomm isn't going to grow unless they have an asset like NXP. It validated, what we had been, kind of the edge, the 750 hours that had been developed all along. Now, I don't use this to boast because 750 hours is a hell of a lot of time, and that's building an edge. And you can't make whimsical, I can't just say, oh, I'm going to buy Amazon at this price, or, just kind of knee-jerk reactions. Building an edge takes true, I think, bottoms up, tops down, in every single aspect. It takes true differentiation where you are the thought leader, and you can find a company, discover it, and appreciate it, and be able to develop relationships, not just at the top, but throughout the entire supply chain so that you can understand what's going on. And that's why developing an edge is extremely hard. It's not easy to invest and make money. I'll be the first to admit it. But there are areas, and I think this is one example, that active investing or investing for the long term can be very profitable, but it takes a long road to get there. Now, NXP's gone, so life after NXP, last slide, autonomous driving index, something we created. I want actionable ideas for you guys. It's something that I'd spent about 3 months on. NXP's CEO told me they were the leaders in autonomous driving, but afterwards, who do you invest in? You don't invest in the Teslas. They're the end beneficiaries. You don't invest, you may be partial in Google. They're the end state beneficiaries. Driverless cars will not happen for around 30 years. In between then, you want to be involved in the supply chain. And I can talk about more of this offline, but these are the actionable ideas. These are the companies that NXP, we don't include NXP in this because the value has been appreciated, but I had spent around 3 months talking to all the suppliers, and I do think this is the trend that if you want to play it wisely. Do not invest on the headlines. Of these companies, you probably haven't heard of many, but they are all playing a critical role in autonomous driving. Well, yeah. And so I think at the end of the day, it's been a long ride, but I'd like to take a couple questions if we have time. Yeah, I mean, so that's a great question, and we own around 25 stocks. It's a long-only portfolio, and 5 years is something that's kind of what I call the pain arbitrage. It's the companies like a GE that you have to invest in on the belief that they're pioneering the digitalization of industrial assets. I think that is one of the most powerful themes. It could take about 3 to 5 years to play out. Cisco, it has been one of our top investments. That's played out a little bit, but they have $180 billion worth of customers that are embedded in the install base. And they're shifting from low growth into the services business, from hardware to software, higher growth, higher margin assets. Now those shifts take time, but ultimately are rewarded. So I think that it depends. 5 years is something that everybody wants. You want to take a long-term perspective, but the day-to-day, everybody knows, is very difficult. And so if you're going to invest for 5 years, I think invest in a Panera. I think invest in a Starbucks. I think invest in potentially a Costco when it comes down. But be willing to wait 5 years, because otherwise it's going to be the market will appreciate, yes, around probably 2 years ahead of it. So I think a 3-year time horizon over a 5-year kind of investment cycle is fair. And I think Costco, Panera, Starbucks are 3 in the retail space, GE in the industrial space, Cisco in the IT space. All right. Well, thanks a lot, guys.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.